Hello traders, it's Tuesday, September the 24th. This is John Kicklighter, Chief Strategist for DailyFX.com, here to give you the FX market wrap-up over the opening 24 hours of trading this week, and an outlook for what we can expect in the 24 hours that we have ahead, and certainly looking a little bit beyond that. We had a significant fundamental transition this past week when we saw the Fed deliver an unexpected surprise in a no-taper format. All right. Now, considering how influential taper has been to, or the Fed stimulus program has been to risk taking, we would expect that that deferment of a reduction in support would naturally lead to a bounce in risk appetite trends. While that did happen initially on Wednesday, we were severely lacking for follow through. So this week, we are kind of on a high wire. Are we actually going to see a meaningful correction of risk trends this week? Or are we going to see a continuation based upon the expectations of external support from central bank stimulus, including the Fed, that keeps things going forward? All right. What we've seen so far is not very encouraging for the risk-positive position. We start off our conversation here with the S&P 500, my preferred measure of risk measurement. Why? Because it not only reflects the appetites of the standard investor when they want risk exposure or a higher rate of return. They usually go to equities and sacrifice their bond exposure and vice versa. So it has that element, but it also has that very direct relationship to stimulus. All right. Why does stimulus, and this is actually the Fed balance sheet, but that's a reflection of stimulus, why does stimulus help out equities? Is the Fed actually buying equities? No, it's not. The only central bank that currently is doing that, or major central bank that is doing this, the Bank of Japan is doing this in relatively small amounts. And note the difference in the performance of the Nikkei 225, considering that the Bank of Japan is buying its equities and the S&P 500, which the Fed is not. So how do we have this very significant relationship? Is it happenstance? I think a lot of people consider this to be happenstance. Well, it's not. It has a impact via this relationship. Stimulus has a negative implication for volatility, meaning when we have stimulus, it naturally lowers the assumption of risk that individuals take. All right, so with stimulus, you actually reduce volatility. This is actually flipped upside down, so when I flip it right side up, volatility or assumed risk reduces. Why? Because I presume that anytime the markets see a significant correction to the downside, I feel that the Fed and other central banks will step in and help us out. So there is that sense of what we call moral hazard that produces a very significant correlation between the S&P 500 as a risk measure and stimulus. That helps to reduce expected risk in the capital markets. All right, so that's how we have the relationship here. But as I said, this past week we were talking about the surprise outcome, or surprise for most, that there would be no taper in September. A couple policy officials have come out since then, including Esther George and Richard Fisher, two central bankers, one a voter, one not a voter, who have said that their credibility has been put at stake because they have not adjusted after having led the market to its expectations. Now, Bernanke certainly did not make any promises, but at the same time, they certainly did lead the market to those assumptions, considering that we have had some significant adjustments, particularly in the Treasury market. And subsequently now there is concern that forward guidance on interest rate outlooks might not be as effective, because the market will always be concerned that the Fed will change its opinion. All right, but with that avoidance of that taper, all right, not taking out the stimulus, we should theoretically see a rise in risk appetite trends that would last more than a day, because we only had a one-day move here. So why isn't this measure of risk continuing its move to the upside? Well, to begin with, and this is what we discussed more in depth last week, we didn't have much taper priced in. All right, the S&P 500 anything that is on this chart, there's a number of assets that are taper sensitive or yield and risk sensitive. Anything on this chart that is higher priced would be pricing in more taper. Anything lower is pricing in no or little taper. This is actually moving against taper expectations. So as you can see, the equity market was not pricing this in at all. The US dollar, in contrast, did have a little bit of speculative exposure to that taper speculation, but we did retrace some of that move before we actually even had the release. So you did have the big drop off afterwards, but we have subsequently seen a rebound. So a lot of that contrast, a lot of that expectation, the surprise quotient, if you will, was undermined by the fact that we did have relatively limited taper fear priced into the market. So subsequently, that wasn't a big short-term implication. Well, the taper question, and I think that the taper, ongoing taper considerations about October versus December, I'm already starting to see headlines related to this. I'm not going to start with this Octaper or whatever they're calling it just yet. I think it's a little bit longer down the line. I think that these markets are a little bit more sensitive to the more traditional measures of risk on, risk off. All right. My concern is that we have seen a supposedly risk positive, or at least risk neutral, so that we can maintain a bullish bearing on these otherwise risk-sensitive assets like the S&P 500, and yet we have a pullback. All right, this is very tentative. It's not a full-scale risk aversion move by any means, but it does set the tone for something that's a little bit more concerning. If we do see a deeper reversal, a further pullback, it can spread to otherwise sensitive assets. Now, when looking for your risk-sensitive assets, you can look towards different markets or different currencies. The equity market certainly is at the top of that list of sensitivity, but the US dollar happens to be one of the most risk-exposed safe haven assets. However, the dollar itself is somewhat overbought, so I can't really call it a oversold risk currency unless you're trying to pick out specific currencies where the dollar has seen a significant drop. You can see in these relationships that I have since the June 19th rate decision that we still have, that we do have some particular exposures here. The dollar yen, where the dollar is most overbought, the Kiwi dollar and pound dollars where we're most oversold on the US dollar. So if you're expecting a risk aversion move, you would look for the safety of the US dollar. You look for a dollar where it's oversold, right? All right. So tentatively this morning and early Tuesday trading in the Asia session, you can see this very early pullback on this Kiwi dollar. This is a 4-hour chart. We had that massive breakout here on an incredible move from, we'll say roughly 77.50, moved all the way up to approximately 84.50 or 84.25. That is an incredible move. It's actually 700 pips plus from peak to trough. And that had occurred since the beginning of September. Very aggressive move. So this tentative pullback is very attractive. However, we're fighting short-term momentum. You must be very careful because we also talked about last week in a strategy video how risk trends also happen to follow yields. And as for the Kiwi USD, you're talking about an exceptionally high yield exposure for the RBNZ, one of the few currencies that's expected to see a massive round of rate hikes over the coming 12 months. All right, it's very unique in that position. So the Kiwi dollar does have its appeal, as does the pound dollar if you do have risk aversion. However, this is a prevailing trend in the short to medium term, and if you can't really fight that theme unless you're going to have an aggressive pullback, confirmation. The more confident you are in a risk aversion move that is more market wide, the better the opportunities are for looking for setups, looking for trades. But we need that confirmation of risk aversion. Now, a little bit more immediate in their exposure to risk trends. All right, I'm looking at the yen crosses specifically. and I made specifically a strategy video for Monday about the yen crosses. And I think it's interesting if we look at the yen crosses that there are two elements that we need to follow, and this makes them perfect measures for risk trends and especially sensitive to risk aversion. When you see the yen performance in September, last September, this is a measure of their aggressive yen depreciation performance. And the scale gives you, just like we saw with the US dollar, a relative performance. Where's the dollar more overbought? Or sorry, where's the yen most overbought, or where is the yen most oversold? Up here, the yen is most oversold against the euro. All right, so the euro is most overbought of the yen crosses. And the yen is most overbought against the Australian dollar, or the Aussie yen is most oversold. All right, so that gives you a relative positioning to weed out which currencies are most attractive, which are least attractive, depending on what your bearing happens to be. Now, remember these pairs. Euro yen and Swiss yen at the very top, Aussie yen and CAD yen at the bottom. All right, I want you to remember these because these pairs also have a sensitivity or different sensitivity to the traditional measures of risk trends. And we can use the Nikkei 225. I think that is a little bit more appropriate. It measures risk trends in the Japanese market. We use the S&P 500, of course, but I think it's the local measure is a little bit better. Now, the U.S. dollar Japanese yen exchange rate is not a very good risk-on, risk-off currency pair. Why? Because it's two safe haven currencies paired against each other. And it looks decent here, but when I measure them in a statistical manner, this is the correlation, short term, medium term, and long term. So 1 week, 1 month, 3 months, the correlation between the Nikkei 225 and the various yen crosses. Now, numbers might be a little bit difficult, but anything near 0 is very weak. Anything towards 100 is very strong. Just to give you a quick view of this, and I put this actually in the real-time news feed, you can see the measures here as low, moderate, and high. It just so happens that the dollar-yen has the worst measures of relationship, and it looks like this. Right. Imagine how sensitive these other currency pairs, especially the ones with high ratings like these, have towards these kind of fundamental changes, risk on, risk off. All right. So what we see in this relationship to risk trends is we're looking for currencies that have currency pairs, yen crosses, that have a greater sensitivity to risk trends. I think euro yen. Aussie yen, and Kiwi yen are certainly high up on that list. But then you also need to consider which currency pairs have a greater yield. All right, because for those that aren't familiar with the carry trade, what you're doing is you go long a high yield pairing. So the Australian dollar versus the Japanese yen. The Aussie dollar has a high yield, relatively speaking. The yen has a very extraordinarily small yield, as you can see here. All right, so a sensitivity to risk trends this has. If we have risk aversion, the Aussie yen will certainly have a strong correlation to carry trade. This is actually the Deutsche Bank carry trade index, so we see the correlation is very strong. However, the high yield is kind of like a dividend. Somebody that's trading stocks is going to give up the high dividend stock probably pretty late. First, they'll give up the stocks that are highly exposed and have no dividends. Right? Then they'll eventually get to that high dividend stock. The Aussie yen is your high dividend stock. As you can see here, also the Kiwi yen is a high dividend stock. All right? But there are pairs here that are extraordinarily low, if not negative, for yield. So that dark purple line, this bright purple line, is the yen's 2-year government bond yield. There's actually a yield that is lower than the Japanese rate. In fact, there, in an even shorter time frame, there is a European rate. The euro rate is lower than the Japanese yen rate. We consider the yen to be a funding currency for the carry trade, but in fact, its rate is higher than the Swiss and euro pairs. Note that the euro yen is just off of a multi-year high. Okay, that's pricey. That's pricey for a pair that has negative yield. Ditto for the Kiwi for the Swiss yen. All right, at multi-decade high after taking that peak back in August 2011. This presents a very fundamentally exposed to currency pairs, the euro yen and Swiss yen. The pound yen is in a similar situation. It does have a low yield differential, but the interest rate outlook for the UK is looking better. So I don't want to go into the areas of gray. I want to stick to the ones that are most exposed. And the Swiss yen and euro yen are those two yen crosses. All right. So if I'm looking at a real and concerted, consistent risk aversion move, I like a measure of the S&P 500, the Nikkei 225. With that, a drop from the euro yen and the Swiss yen, especially when I'm just looking at these yen crosses, and you can see that the euro yen and Swiss yen are most overbought, relatively speaking. Now, there is some question as to their sensitivity to the Nikkei 225. The euro yen actually doesn't have that problem, but the Swiss yen has it over the longer term. But we can actually see that relationship will strengthen as risk aversion becomes more concerted. All right, so the euro yen and Swiss yen are most interesting. This morning I have a yen exposure, and it's actually through the Kiwi yen. That goes against the medium-term expectation because there is a yen cross with carry trade in the Kiwi yen. So I have to be careful with it. I'm placing my stops relatively short. I have an entry at 82.40. I've placed the stop up here at 83. First target is going to be equal to risk, so 82 flat. All right. So, 190. But I'll watch this very closely. I'm not looking for big moves necessarily. I'll take the first half at that target and move up the stop to break even relatively quickly. But if I'm looking for more concerted risk aversion, the euro yen and the Swiss yen moves are going to be far more interesting because we have already seen from this morning or from the start of this week that we've already covered some significant ground. All right, rounding off that top from late last week and making some more progress on this move. They're all well positioned to this kind of extreme, to this change in sentiment, as are the dollar-based pairs. But you have to be able to pick your pairs correctly. I prefer the euro yen and Swiss yen to medium-term risk aversion. And for the dollar-based pairs, I'm going to be looking at setups like the Kiwi dollar, although it does have that high yield differential like the yen crosses, but it does have potential in that exposure. But then also euro yen and pound yen. All right. Not as much carry trade, but the dollar is not a very prolific funding currency, but it does have some exceptional exposures to risks going forward. So I'm going to be looking at those pairs for risk aversion, and there might not be strong momentum behind risk aversion, so you have to be very judicious about the positions that you take and the size that you do it in. I'll keep a very close eye on these benchmarks and play it as the hand plays out, but you should also be ready for risk-positive moves. Now, in risk-positive moves, I'm looking for pairs that the dollar's overbought or the yen is overbought, and subsequently those pairs have further to move. Also, the higher yield is a greater appeal. So the Aussie USD seeing continuation above this 95 level would be quite attractive, but we have seen that break of this rising trend channel, which has been unnerving for a number of people. In fact, if we were looking for the best positioned dollar-based pair, you would be looking at Kiwi yen and Kiwi dollar. All right, why would the Kiwi dollar do well in risk-positive sentiment? Because its yield forecast is amongst the best of the majors. All right, it is looking at four rate hikes, quarter percentage rate hikes, and no other major central bank can make claim to those forecasts. So that puts it in a very unique situation, a very opportunistic situation, a higher probability of continuation, even though the distance between the previous swing high is not as great. All right, so the Aussie dollar might have more room to cover if we have a strong and concerted risk appetite trend move, but we don't necessarily have those strong implications. You really have to see a retrenchment of strength in risk trends. Otherwise, it's not going to be very encouraging to see a follow-through move on something like the Aussie dollar. It'll be choppy, it'll be troubled the entire way up. All right. Now, in terms of the yen crosses, once again, if we're looking at something like the euro yen, which had made a break to multi-year highs, or the Swiss yen, which did the same, we would be a little bit more cautious of finding follow-through on those particular big pairs because, once again, they don't have yield. All right, they're higher than their counterparts, but how much higher can they go without yield? The actual thing that encourages people to buy up yen crosses. Compare that to the Kiwi yen and the Aussie yen. I'm particularly fond of the Aussie yen in that scenario because they have more room to run and they also actually have very significant yields. All right, that is what we're going to be looking for. So I'm watching the risk on, risk off traditional theme moving away from the taper this week, unless it comes roaring back in the headlines. It's always a possibility, but I'm not going to play it as if it's a sure thing. In the meantime, there is a individual move seeming to be born out of the Kiwi dollar this morning. You have seen a pullback or a short-term trend line break here in the Kiwi dollar and the Kiwi yen. As I said, I took the Kiwi yen trade, though I'm not going to leverage it up on both. I'm going to be very dubious of follow-through because risk aversion is the best chance that the Kiwi dollar has for consistent selling pressure. Otherwise, the yield forecast makes it a very attractive long position. So something like the Kiwi CAD, I know it looks great because it just had this break for those people who have been watching it, but realistically this is a high yield versus a investment currency, so two high yield currencies, and it's not going to be very easy to keep it moving down if you're not playing towards the risk theme, which this one doesn't do. Alternatively, there also is a Euro Kiwi, which I am very interested in. If you think the Kiwi is going to drop individually, which is a difficult thing for it to do, but if it's a possibility, maybe a fundamental theme comes out. This is a very aggressive move, a nice hyperbolic move. Potentially seeing this catalyzed to the upside is a possibility, though buying into the euro or selling off the Kiwi, which has the highest yield potential going forward, is not going to be a very strong fundamental position to start off on. Now, speaking of the euro, there has been some very interesting event risk over this past opening 24 hours and over the weekend, but we get a sense of how it came out with the euro dollar drop and the euro yen drop, of course, as well. If it were a positive outcome, we wouldn't expect these currencies to do very well, or we would expect these currencies to do well if it was a positive outcome for the euro. However, the euro has actually dropped. What was the outcome? Well, the German federal election actually came out very much in favor of Angela Merkel, the German chancellor, so she's doing her third term at the head of parliament. She needs to make a coalition, and it will take some time, but it looks like she is going to maintain her support of the Eurozone and will have a pretty strong negotiating standpoint amongst the German politicians in the Bundestag, with trying to push forward support for troubled currencies, especially Greece and Portugal, two countries that are looking for further accommodations, further laxing of their targets. So that's actually encouraging for the European region. So why is the euro down? Well, we also had this PMI figures, the forecast, particularly in the services sector, the activity measures, more timely readings for the Eurozone, those improved as well. The thing that really stands out, however, is some of the commentary that was offered by Draghi. Now, I put this as green because it is supportive of stimulus, and this is my manic crisis calendar is a measure of risk assessment or financial crisis assessment. But his suggestion that they could introduce a new LTRO program, or long-term refinancing operation program, is a very much a negative for the euro. Why? Because it lowers interest rates in the Eurozone and floods the market with stimulus, the same thing that a regular QE program does with the Fed in the United States. So that is negative. It's not a overwhelming negative read, but it certainly does have that negative implication. Some event risk is coming up from the euro and will continue to come out throughout the week, but nothing overwhelmingly tremendous. So with the euro, I'm not expecting individualized moves, and that's going to be more of a struggle for something like the euro pound, which isn't guided by risk trends, and also for the euro Swiss. Now I had this trade actually to the long side playing the bottom of this wedge. It broke this wedge, didn't hit my stop, which is actually below this previous swing low, but I'm cutting. I'm cutting out for, I think, 25 pips. I don't want to hold on to a position that's not what I was originally intended. And while it can hold this range low, my intention was to hold or trade this wedge. All right. Considering that we have made a move against it, I'm not going to just adjust the stops and hope for a trade to go my way. I'll see what happens. Although some people have asked me, have I gone short? No. I think that this is limit bound to the downside. The 120 floor that the Swiss policy officials put in place has unlimited, essentially, move to the upside, but it's not likely going to get a lot of strength either way. So I'd prefer to stay on the sidelines, seeing what happens with the euro Swiss going forward. But we can find these alternative currency pairs that don't have exceptional exposure to the traditional or the standard risk on, risk off themes. But that's where most of the potential lies. And of course, if I were looking at complete potential, where the most market moving activity could come from, it would be from risk aversion. There is just so much open space to cover on a risk aversion move. However, going back to one of the strategy videos last week, potential does not necessarily equate to probability. It is a lower probability to see this go down in a meaningful way because there are elements that are keeping it up. Whether you think that they are steady or sturdy or not, they're still there. So have your options open to you. Have setups for risk positive trends and risk negative trends, and be ready to apply as the market shows its hand. All right. Good luck trading out there, guys, and we'll do another daily video wrap up tomorrow.